Welcome to FM Radio, your go-to podcast for everything in the world of funds management. Whether you're an experienced advisor, a seasoned investor, or just starting your journey, we're here to break down the complex world of funds management, all in a way that makes sense. Each episode, we'll talk to the experts to get their insights on everything from asset allocation to risk management and give you the inside track on how decisions are made. In this episode of FM Radio, we're venturing out beyond the familiar world of the ASX 100 and out into the small caps universe. Here to guide us out beyond the final frontier are Justin Woerner and Gary Merkel, two small cap managers who are in charge of Elston's emerging leaders portfolio. Justin is a highly respected portfolio manager who has over 25 years industry experience. He's worked at companies like Hyperion and sat on the boards of not-for-profits. Gary has built his career at Elston working initially as an investment analyst across large company and multi-asset strategies and growing into the role portfolio manager, partnering with Justin. Welcome to the show, guys. Now, I'll just have to open with an apology. You probably thought, looking at the label, it's called FM Radio. If you're expecting something that had iced coffees being given away in a van out the front and band T-shirts and tickets to the next Coldplay concert, it's not that at all. Of course, today is actually about funds management. That's what the FM stands for. So it's really not very rock and roll. But, when I think about investment gurus, they're kind of the lead singers and the guitar gods of the industry. So, for you guys, who are some of the stars for you? Who are some of the investment gurus that really ring true for you?
For me, it would be Peter Lynch. Really struck a chord with me early on in my career. I read Beating the Street or One Up on Wall Street, and I loved the practical applications he talked about within his book, and it was about analysing different retailers. Some of the examples he used were going to the mall with his family, had his wife and his kids, and he asked them what type of retailers they were really liking at the moment. And then he would go in, have a look at their products, have a look at the store, and go home and dig up the financials and ascertain the profitability of the store and the potential store rollout. Just found it as a really exciting real world sort of example. And that struck a pretty strong chord with me early on.
I like the hands-on nature of that. Is bringing it back to reality, things that are a bit more sort of bricks and mortar and a bit more relatable. What about you, Justin? Is there any sort of gurus that you've actually gravitated to over the years?
Yeah, if I think back to sort of when I was in university, there was a series of books that came out on Warren Buffett. So I think everybody's aware of Buffett and his influence on the industry and markets. So I think outside of that, Peter Lynch, Philip Fisher, they were both sort of very influential. So it's sort of a mosaic of influence. But I think the underlying theme across a lot of those classic investors was the fact that they took the time to look at their investments as though they're investing in businesses. They took the time to understand the businesses, and they took the time to really think about the longer-term fundamentals of the businesses that they were investing in.
No standout quotes. Any sort of standout quotes that you guys have sort of thought, that'll make a good tattoo?
Not sure about tattoos, but Philip Fisher, actually, his son, I think it was Ken Fisher, who started Fisher Investments. I think he's the one who's been credited with time in the market beats timing the market, which is another thing that we strongly believe in as well. So it's really about investing for the long term and then staying invested.
That's got to be a classic, doesn't it? Because I think that's probably maybe something that even people who would regard themselves as being experienced investors would still be tempted to start looking a little bit closer to home, a bit more at their shoes and going, what's happening in 3 months and 6 months? There must be such a tempting thing to do, but you've got to remind yourself that you are in for the long term. What sort of horizon do you guys look at?
We're thinking 5 years on an ongoing basis, but it really goes beyond that. Like we're looking for businesses that are very durable, and ideally we'd like to hold them for 5 to 10 years. So it's that longer term mentality. And
has that held true for you? Have you found the strategy you've been working on is 4 years old, is that right? So have you found that that's been true for you, that you've gone, okay, we're going to pick and stick, and that's sort of worked for you?
So of the 9 that have come out of the portfolio, it's really only been 3 or 4 that have come out because they haven't met our investment thesis. So we've had a couple that have been taken over. We've had a couple that moved into the top 100. So that's outside of our universe. So we sell those. So it's really, 20 businesses in the portfolio, and we really do sort of think about that longer term investment. longer term thesis for these businesses.
We're talking about longer term, and I think that's a really strong topic, and a lot of people would be nodding and going, I agree with that. That's what we should be aiming for. But if you think about, you guys have both been doing this for a long time now, and I wonder what sort of lessons you would learn. Often I've heard people talk about, all different industries, and they talk about the biggest lessons I've learned are probably from the mistakes I've made. What would you think are some of the key learnings that have stuck with you as your career has developed?
Yeah, it's a big one. I think always being humble is incredibly important. I'd say that would be a recipe for disaster. If you were to be overconfident in your conviction over a position, you need to continue to review that and look to enhance that level of understanding.
Yeah, and I guess nobody is going to have a perfect record. I mean, I couldn't imagine there any portfolio manager in the world who says I've got a 100% strike rate.
It's interesting talking about strike rates. If you can get things right more than half the time, you can be an exceptional investor. It's an interesting dynamics when you take a step back and think about it.
And that's probably one of the big lessons, is just keeping your ego in check, realizing that there's a lot of things that you don't know.
So as you're saying, you need to be aware of that in your own decision making and your own analysis. It's not just the two of you running the strategy. So does that team environment, does that help that to overcome that, a little bit of more team input?
Yeah, it does to a degree. I think, it was something that we were very aware of when we were putting the strategy together 4.5 years ago, 5 years ago. So we've put a lot of guardrails into our process. One of those would be the function of the team. So we are team-based. It's a team-based decision. For a business to go into the portfolio, all three of the portfolio managers need to agree to it. And with any team, there's different dynamics. Gary, Bruce, myself, we all have different approaches to investing, slightly different thought process that we go through. So we get good discussion. We get sort of good pushback, and we get a good set of alternative ideas within the team. So I think that's part of the way we sort of address the emotional or biases potentially. But it's also really just through the structure that we've put in place and the guardrails that we have within the process.
So Gary, I can picture, these sort of meetings where the discussions are taking place. I'm never that person in the room, but I can imagine there would be ideas that occasion would come in, and maybe they come in multiple times and they get knocked back for whatever reason. That's obviously a healthy thing.
Definitely part of the discovery process for us. As Justin has talked about, it's a concentrated portfolio of 20 holdings. As he mentioned, 29 holdings over the duration of the fund. So there's very few names that have been in the portfolio. So we like to take our time in making sure that we're getting the right types of businesses. So it hasn't been uncommon for, say, myself or Justin to have an idea, one of the other team members disagreeing on a key aspect of it, which has resulted in it not making it into the portfolio. I think it's quite healthy in that discovery process for finding out whether it is of the quality that we want.
And Elston is very much about that in terms of portfolio management. The team kind of setup is key to, I guess, the way that we do things. Is the process the thing that makes that happen? Make sure that the right kind of rigor is applied to the new ideas? Is that how you keep the team fresh and different perspectives are held true?
Yeah, I think so. We don't work on the concept of having like a star stock picker or anything. There's no key individual within the process who makes the decisions. It is very much back to that team-based and that discipline that makes sure we go through the same process for every business that we bring forward. And I think that really sort of builds on the repeatability of the investment process and really makes sure that, we're looking at every business in the same way.
So that's interesting. I think that's a great way to kind of, I guess, introduce getting to know you guys. Like you're talking about the Elston philosophy and process, which is across all of Elston Asset Management. You guys are obviously in the room because you're all about small caps. And I think this is an interesting topic because in my mind, there's probably quite a few misconceptions around what small caps actually is. For me, someone says small caps, I'm thinking small companies and, small is quite small. But I guess let's just talk about what small caps is and what it is broadly, but also how you guys define it or what's the universe that you work within. Are we just talking about small companies or how small are they?
Well, our universe is defined as the ASX 101. So that's the 101st biggest business on the ASX down to 150 mil market cap. So really within that range, there's about 400 to 500 businesses that sit in our universe. And They tend to be in the billions at the larger end. And then, as I said, that 150 million at the smaller end. So they're not that small really, for particularly at the upper end.
Well, it's interesting because you were saying, I think you said before, we used to have something in the portfolio and actually it ticked into the hundreds. So we had to let it go because you want to stay this side of the fence. So, that must have been a fairly sizable company. Like it's not a small company.
Yeah. So it's sort of the top end of the small caps. You might get a business that might be valued at say 10 billion. I think the average valuation across the index, which is the small ords, is about $3.5 billion. So there's a lot of $5 billion, $6 billion businesses in the universe.
And I guess you're still looking to create some diversification within your universe. How do you have exposure to things like mining and finance within the small caps?
Yeah, we tend not to have exposure to mining. We tend to find that in the small cap space, they're very low quality businesses. It's not like if you think about large cap, you got BHP or Rio Tinto. In the small caps, you end up with a lot of just really small exploration businesses where they're sort of banking on being successful at one mine site. And we find that's just way too risky for us on the longer term. We don't have the ability to predict where commodity prices will be in 5 years' time. And just that single exposure scares us as well. So we don't really invest in commodity-based businesses, but we do have exposure to, a lot of retail-based businesses, a lot of IT, software-based businesses, a lot of healthcare businesses. We have some financials in the portfolio as well. So we do get exposure across several sectors.
We look to play different sort of exposures through different means. As Justin mentioned, we don't invest directly in commodity businesses, but we do like the longer term thematic around increasing volumes from mineral commodity businesses domestically and globally. We have a business that sells tools, smart tools and software to exploration mining businesses. And so we get that exposure to the volume thematic within mining, but we take away that direct commodity exposure, which we find to be too hard to forecast over our investment horizon. So we look for alternative ways of gaining exposure to different parts of the market.
And yeah, you're talking about getting that sort of diversification, but you said you only had like 20 holdings. Like that sounds like a really small number. Is that enough?
Well, going back to a comment made earlier just about building up evidence, academic research, back tests are really underpinning the different sort of steps within our process. At the beginning, when we were thinking about the number of businesses that we wanted to hold in the portfolio, we went through the academic research out there that suggests different number of securities in your portfolio to get a level of diversification. And the academic research out there suggests that you don't need to have 50, 60 securities. You can actually pick up quite a lot of the diversification benefits from holding as few as 15 to 20 securities. So we took that academic research and then built a back test to look at the market that we're investing in and found similar outcomes. So we think that you can get an adequate level of diversification. You can actually get the bulk of the diversification from holding 20 securities in the portfolio. And the benefit of doing that is we can fill it full of our high conviction ideas and really maintain a very high threshold for the quality that goes into the portfolio.
So when you talk about high conviction, what gives you that conviction? What are the boxes you're trying to tick to say, yep, I absolutely believe in this business? What sort of things are there? How do you guys define quality?
Yeah, it's interesting. Quality probably does mean a lot of things to different investors, and I'm pretty sure there's no investor that would say they invest in low quality businesses. But for us, really, the way we sort of think about it at a very high level is the ability to weather the storm. So if you think we're investing for 5 years, 5 years is a pretty long time. A lot of things can happen in 5 years, and a lot of things that we probably don't even expect to happen will happen in 5 years. So really what we're thinking about is what characteristics inside of our investments allow those businesses to be best positioned to weather those storms that come their way, whatever that storm is. At an industry level, we're thinking about structural tailwinds. We don't particularly invest in businesses with high levels of regulatory risk or government-related risk. High barriers to entry. So, businesses where it's very difficult to form a competing product or it's very difficult to enter the industry and compete against them. Businesses that have really strong value propositions, that makes them a bit more stickier. It makes it, once again, a bit harder for competition to erode their market share. But it also tends to give them pricing power as well. So, if you've got a product that you really love, then you're probably more likely to pay a bit more for it. So we think that gives the businesses pricing power, which then, as we've seen over the last few years, provides them with protection around inflation.
And it's interesting, you talk about, being ready for any storm, because no one can anticipate what storm is going to come over the horizon. Strange things happen all the time. And currently we're living through a high interest rate environment, and we're seeing that affects different demographics in different ways, which means that's different sets of customers. So the younger consumer who's got a mortgage, who's really feeling the pinch, might be pulling back on the spending, and then maybe an older demographic who's actually earning money from their savings is still out there spending. So I'd imagine that if you talk about some of your perhaps retail clients, some of them will actually still be benefiting in an environment where you feel like spending should be curtailed. It actually isn't working that way. We've
definitely noticed that inside the portfolio. The higher interest rates are impacting on the different demographic cohorts differently. So one of the businesses we own is Nick Scali. Nick Scali's been doing reasonably well. It's a higher quality product targeted at a middle-aged to older demographic. One of the other businesses that we own in the portfolio is Baby Bunting. So Baby Bunting has really been struggling over the last 18, 24 months. It's a cohort which is much younger. It's probably a cohort that's more likely to have just taken on a mortgage, going from potentially dual income household to a single income household for a period of time. So it's been really tough for that particular cohort.
Yeah, and it's interesting too, because it brings us back to talking about what is quality. And I think that definition is great, being able to weather any storm. We're looking for that resilience and that underlying fundamentals that just work. But then in terms of going and finding those companies, that to me is really interesting, because I think you've talked about it before, where you talk about it's a little bit of an under-researched universe. So compared to, I guess, large caps, there's a lot known, there's a lot published. They've got people in-house publishing out all sorts of information, so everybody knows how well they're doing or how well they're not doing. But that's not necessarily the case with small caps. So how do you go and how do you get the information? How do you do the research?
Yeah, the process for gathering the research is quite different for the smaller part of the market. It's a lot more hands-on, because there isn't that higher level of published research that's out there. You really need to go knock on a lot of doors and gather it yourself. So we will have quite a lot of meetings with the company, and then we'll utilize expert networks to help build our understanding around different sort of nuances relating to the company. It could be competition, could be industry, could be just the way the product's used. So a lot more hands-on. You've got to roll up your sleeves and get in there and do it yourself.
So you guys actually go out and you're not talking in a metaphorical sense. You're actually saying physically you go out to businesses and you really want to meet them and see them, and I guess I eyeball them and kind of go, what are you really about? Because it is the conviction of the management.
Yeah, we definitely make sure that we've met with management at least once face-to-face before investing in a business. And then we continually sort of touch base with management. There is a lot more sort of getting out of the office and visiting these businesses or visiting other participants within the industry, whether that be competitors or suppliers, customers, trying to understand what the customer really wants, how they feel about the business. But it is challenging. If you think about some of the businesses we have in the portfolio, some of them are global businesses and they're in niche markets. So we're trying to research niche markets where there's not a lot of publicly available information. So it does make it very interesting and very challenging, but I think it's just about doing the work. And that's why we've got 20 businesses in the portfolio, right? Because it's really important for us to be able to get confidence over these businesses. And it's really important for us to understand the businesses that we invest in. So we take that very seriously.
I find it funny though, because I can imagine if you were trying to do the same thing in an ASX 100 large cap space, getting to meet the CEO of Commonwealth Bank or Rio Tinto would be going, I think my diary's full. Yeah. I don't think I have time. I can't give you time. But whereas you can actually, in the small caps world, I mean, that's probably the flip side is I don't have as much the depth of published information necessarily and the data that's fresh every month. But you do actually get to say, well, maybe I can get to have a coffee with this guy and actually
we tend
story.
We tend to get very good access to management. If you're in the large cap team and you're researching ASX 100 businesses, you've got a very slim chance of getting a meeting with the CEO of CBA or BHP, whereas pretty much all the meetings that we do with companies will either be with the chief financial officer or the chief executive officer.
It sounds like you're getting a lot more qualitative stuff that I guess other people wouldn't necessarily get. Would that be true?
Yeah, absolutely. So we can look at the quantitative data, and that will tell us whether a business has been of high quality in the past. But you really need to turn qualitatively if you want to ascertain whether or not that business is going to sustain or increase in quality throughout our investment horizon.
We're just finding a lot of pieces to the jigsaw and then just trying to put the jigsaw together.
Yeah.
Really. So it's multifaceted.
It feels like investigative journalism. I feel like you guys are sort of, what was the Watergate scandal? The guys, Dustin Hoffman and I don't know which one of you is Dustin Hoffman or Robert Redford. But you know what I mean? Like you're actually going to go out there and you're going to find stuff that maybe other people haven't found.
Yeah, we do think of it as being an information advantage. So, and it is about collecting the information and then sort of, sorting the pieces of the puzzle out and putting them together. So the ability for us to go out and find that information is what we see as one of sort of the critical advantages to our longer term outperformance.
It feels like you guys, when you start talking about the research and the face-to-face contact, your eyes light up a little bit. Is this something that's the satisfaction in the job? You really enjoy finding out something that maybe someone else didn't even know?
Yeah, I think so. It's very challenging and it's very rewarding. We'll have like a couple of key questions that we want to understand and answer. And then it's all about setting out, okay, so how do we actually answer that question? All right, we need to go and talk to X and we need to talk to Y. We need to research A and B. So it's a discovery process that we go through then to really be able to answer the questions and then be able to really build confidence in the thesis, or alternatively work out that we were totally wrong and move on to the next question.
Yeah, I've got a picture of you guys in high-vis vests and hard hats actually being on the factory floor. Do you literally do that as well? I mean, I guess it's not just boardrooms. You actually are on the production line a little bit?
Yeah, that's part of the job and that's great. I enjoy it requiring that additional level of due diligence, but it does come with its downside. We get great access. The management executive team are always interested in or keen to talk to institutional investors, but they'll always give you a glass half full perspective of the business. So part of our responsibility is trying to triangulate what they're telling us to ascertain what's the truth and where things may be a little bit bit rosy.
Yeah, I guess that when you talked about meeting with competitors, if you could, that would be fantastic.
Yeah, we'll talk to past employees, talk to past board members. We'll turn over every stone we can to help build our understanding around the business.
That's interesting, talking to past employees and to past board members, because that would speak to governance. I find that quite interesting to go, well, if someone has left, why did they leave and what do they know? So not be scared of finding things that maybe are not 100%. I think across all of that is really interesting for me is that it just, I guess, reminds advisors and the ultimate investors that you're buying the company that has customers and it has a product and it's looking for an advantage. And it feels like it's very down to earth and a reminder of people about this thing being, very tangible, very relatable. Brings me sort of back to what you were saying about the Lynch quote. Like, these are real things that are serving people, meeting a demand. That just sounds like that's what small caps is really all about.
That's a lot about how we approach investing. So it's always fascinated me, actually, to go off on a little bit of a tangent. If you were an actual owner of a business, if you had capital invested in a business, I don't know, just say it was an auto tire business or something, right? You wouldn't sell that business and then buy a restaurant business because you think the consumer is going to spend a lot of money over 6 months, and then sell your restaurant after 6 months and buy a supermarket because you think the consumer is going to pull back on their spending a little bit. But if you look at a lot of portfolios in the market, right, there's that level of turnover. So we just like to find businesses that we think can grow, where we think we can narrow the range of outcomes. We have a good level of predictability in these businesses over the next 5 to 10 years, and then hold those businesses over the next 5 to 10 years.
The other thing that probably is worth looking at is when we talk about investing in companies and we're looking at the long term and we want high conviction, but there still must be points where you would feel pressure when maybe in the short term things aren't looking as good as you were hoping, you would probably cop a lot of, not criticism, but a lot of questions. Why did you buy that company? Have you gone through a period like that? I know we talk about 4.5 years. It's been an interesting time in the world in the last 4.5 years. Like, have there been times when you've actually had to stand your ground?
Yeah, there certainly has. And it's really interesting working in a industry where you're basically assessed and reviewed on a monthly basis based on your 1 month performance numbers. But yeah, 2022 was a really tough period for us. It was a period where I think globally investors woke up and realized we're not going to be in a low interest rate, low inflation environment forever. The past is not the future. We've actually pivoted, and we're now in an environment of high interest rates, high level of inflation, and potentially lower levels of growth. So that was a pretty tough time for the strategy.
So what helps you to hold the course there? I mean, does it once again come back to that process, the faith in the process?
Yeah, it's knowing that we've done the work prior and everything has been built around delivering longer-term outperformance, knowing that there will be periods where you are going to underperform, but everything has been designed to deliver that longer-term outcome. So for us, it was really about not letting the emotions overwhelm us and really holding on through what was a pretty painful period.
And am I right in saying the fact that you're putting on the high vis vest and knocking on boardroom doors, to me feels like that's probably different to a lot of other portfolio managers' approach? What else is different about emerging leaders, the Australian emerging leaders?
If you look at the portfolio's characteristics, you can pretty easily see that it's quite different from the benchmark. A metric which is used in funds management industry is called active share, and that measures how different your portfolio is relative to the benchmark. And we tend to sit about 90% or above, which means the portfolio is extremely different from our benchmark. And then when we look at a lot of our peers, we can see that we are of a more higher quality focus than most of our peers.
When you say you're very different from the benchmark, I mean, that to me would tell me that as things move, and we talk about volatility, that they're zigging and we're zagging. Is that how it works?
Yes, I think that's fair to say that our portfolio will at times perform quite differently from the benchmark. So an example could be, say, when commodity prices are running, we don't own commodity businesses within the portfolio. We see them as being too risky. So there are periods where commodity prices will run and that will drag up the benchmark and we will not benefit for that. And then vice versa. If commodity prices were to detract, we wouldn't be feeling that.
When you sort of talked about true to label, are you saying that there's a hard fence at the border?
Yeah, that's exactly right. We are true to label. We've got hard rules within our mandate that we have to exit businesses within 12 months if they go into the ASX 100. We can see for a lot of our peers that isn't the case. They have different sort of setups where they elect to hold on to businesses that go into the 100, and it's not uncommon for some of our peers to have quite a lot of their portfolio allocated to top 100 businesses. That's just a preference at the fund manager level. We have elected to go down this path because we don't want any unintended surprises for the advisors or the end investors that are allocating to our fund. We want them to have comfort in knowing that when they invest in Elston, they're going to get a small cap portfolio that's concentrated and exposed to quality businesses. You know what you're going to get.
So I guess that would mean if an advisor was saying, I actually want a true to label small caps and I want a true to label large caps, and they're not going to get that overlap either, I guess. Everyone's sticking to their knitting. Is that an advantage for the investor as well?
Yeah, we think so. And that was part of the thinking why we've gone down this road. We think it wouldn't be, it's not great to have overlaps. Let's say you have a portfolio where you've got realestate.com, which is a top 100 business within your large cap portfolio, and then you have a large chunk of realestate.com that's in your small cap portfolio. It's not ideal. It's probably not what the investor was intending, having those overlapping securities. So that's why we are true to label, and like to keep that separation.
Another thing we haven't talked about, I guess, just in general about small caps and large caps, and I guess, if someone was investing in some ASX 100 companies, they'd be thinking, I'm probably going to be looking at a pretty good dividend yield from certain large companies, and perhaps small caps lean more towards capital growth.
It's definitely capital growth. Small caps are inherently younger businesses, so they tend to be at a different stage of the business cycle than their larger counterparts. And during that earlier stage of the business cycle, it's about reinvesting and trying to grow your market share or grow the business. And that takes away from your cash flows, which could be distributed back to investors. That's quite different for a lot of the large cap counterparts, where they're a lot more mature in their relevant market. There isn't the opportunity for them to continue reinvesting high proportions of their cash flows back into growing the business. So they are electing to distribute them out as dividends. So different sort of return profiles for the different market segments.
We talk about the name emerging leaders. So you're trying to get in there and just find them just before they've become what they've become. Like, how do you do that? You're trying to spot sometimes the early signals of the next phase of their growth. Where do you find those clues?
Yes, that's certainly what we're trying to do. We're trying to find those businesses which are emerging as the leaders of tomorrow, those businesses which will be able to dominate their markets over time. I think the other thing that we've deliberately done within the strategy is we're fairly conservative around the amount of money that we think we can manage. And that gives us the ability to go a bit deeper into the market.
Mm-hmm. Yeah, there's a lot of research in that. I mean, there's certain times of the year when you invest a lot of your time into research. I feel like maybe I've dragged you into this podcast. This would probably be one of the times of year where you'd be going, I need to get out there. I need to look at more companies. And, it's a lot of work you do put in. Is this one of the times of year that I've interrupted your flow of research?
Post-reporting seasons is normally a pretty busy time for us. We normally try to get out and see a lot of companies. Reporting season, we get access to information. We get access to management commentary on the business, on the environment, the landscape. So post that, we tend to do quite a lot of company meetings, either searching for new ideas or touching base with management from existing holdings.
Are there big themes that you guys have been looking at over the last couple of years and into the future? I talk about demographics and, aging population. I'd imagine that things like that are actually flowing through in lots of different ways. Are you seeing those sorts of themes as being interesting things that might lead to green shoots and future growth?
It's an interesting question. And I would say in short that those big themes, AI as an example, is not one that we're explicitly looking to target. But yeah, I'd say an example of a business which could directly benefit from AI would be Megaport, which is a company in our portfolio that provides connectivity between data centers around the world. They benefit from increasing data consumption and increasing complexity among enterprise customer networks. So we wouldn't be surprised if that business does benefit from an increased consumption of AI, but it's not something that we're explicitly targeting or part of our thesis.
You'd probably call it maybe a softer theme within the portfolio. So the underlying influence from AI and associated with that to some degree, automation as well. So the ability to automate processes within a business and the ability to then lower your OPEX growth.
Yeah, it just feels like if someone's invented a new widget, we should actually wait and see to get the fundamentals right. So it's emerging leaders, but it's not jumping in. It still has to tick so many boxes. And you guys would be so tough on the selection process and tough on yourselves, I'd imagine.
Yeah, we're definitely tough on the selection process. We probably are pretty tough on ourselves as well. I think expectations are pretty high. But yeah, once again, it just comes back to the discipline of making sure that the businesses are going to the portfolio of the high quality businesses. So and especially at that lower end of the market cap. So, really strong focus on balance sheet, so we don't particularly like debt. We don't particularly like debt because we see it as being too risky, especially when you've got a younger business where, potentially the revenue streams are lower or there's less predictability around those revenue streams. So, we do a lot of work around balance sheet strength, a lot of work around cash flow, the ability to continue to fund the growth going forward.
What you're saying about balance sheets makes me think back to the analysis that we did pretty early on in the strategy, where we went through and looked at the past 20 years of defaults in the small cap part of the universe. But it was interesting. Debt was a very common factor amongst the businesses that have defaulted over the past 20 years. I think it was over 80% of businesses that had found themselves in trouble. It ultimately was debt that was the kiss of death. So for us, it's about narrowing the range of outcomes. Makes me sleep easier at night as well, knowing that there's not a lot of debt across the portfolio. And again, going back to building that evidence, we know that having too much debt can lead to unfortunate outcomes for companies. So it's really part of the durability of the portfolio is having those low levels of debt.
I guess in terms of any portfolio management team, you really are trying to build that trust and that confidence from the advisors. We're true to label. We've got these processes. This is how we do things. Everything has to tick a number of boxes before it goes in there. Like you've got lots of discipline around what you do, and I guess that's how you ultimately prove the case. But across that as well, I know you're pretty big on communication.
We think it's pretty important. We think it's pretty important for a couple of reasons. One is, as you mentioned, transparency. We think it's important too for education. We're very focused on educating the investors about the strategy and the characteristics of the strategy. And then I think it's also just comes down to keeping us honest as well. So there are certain metrics and characteristics in the portfolio that we look to maintain. So those low levels of debt, much higher levels of return on equity or return on invested capital, the strong levels of revenue growth. So if we publish those metrics, if everyone can see the underlying metrics in the portfolio, then to a degree that keeps us very honest as well. Because as soon as those metrics start to deviate away from where they should be, then we've got questions to answer.
Absolutely. That's so true. I think transparency is so important. As you said, it keeps you honest, it keeps you true, it keeps you accountable. And transparency is really part of what today is. I think today what you brought through by opening up and being so honest about how you do things, why you do things, and what the brand is really about is just so important. So I really want to thank you guys for coming today and really opening up and sharing some of those insights with us. And what do you think the main takeaways would be from today's chat?
For me, I think it's always just around the long term. I think investing in equities is a long-term proposition. I think too many people get caught up in the short-term gyrations of the market. But I think it's really just focusing on the longer term and then having confidence that the investments that you're making are good long-term investments.
That's great. Well, thanks, Gary. Thanks, Justin. That's all for this episode of FM Radio. We hope you can join us again soon as we tune into another aspect of funds management that affects you and your clients. In closing, I'd just like to say that Elston acknowledges the traditional owners of country throughout Australia and acknowledges their continuing connection to land, waters and community. We pay our respects to the people, the cultures and the elders, past, present and emerging. FM Radio was recorded at The Pod at Cutting Edge Studios, West End, Brisbane. It was hosted by Peter Goodall, and today's guests were Elston Small Caps portfolio managers Justin Woerner and Gary Merkel. For more FM radio episodes and full transcripts of the interviews, visit elston.com.au. And if you'd like to subscribe to our podcast series to make sure you don't miss a thing, you'll find FM radio on your favourite platforms, including Spotify, Apple and Google Podcasts. The information provided in this podcast is general in nature. You must consider your own circumstances prior to making any investment. For more information, go to elston.com.au or speak to your financial advisor. Elston Asset Management is authorised by EP Financial Services, AFSL number 325252.